Good afternoon. You're watching us here on Halftime Report. As you can see at the top of your screens, the indices holding up well. That's the frontline indices for now. The two parts of the market which are doing extremely well this afternoon, we have the banks which continue the rally from yesterday, and we have the mid caps which do even better. So the mid cap index is virtually at the high point of trade. I'm Manglam Malu. With me as always, Ekta Batra. Hi, Ekta.
Hi, Manglam. Yes, absolutely. In the pink of health, might I say. But nonetheless, definitely doing well for the markets. We have the mid-cap index, which is up around 0.6%. We have the bank Nifty, which is up around 0.5% as well. And a good advanced decline ratio on our hands. A couple of key points to watch out for in the next couple of hours, I would rather say, is the Bank of England policy, where the Bank of England is expected to hold rates at a 16-year high of around 5.25%. It would be the last policy ahead of the re-election, so that would be important to watch out for. And besides that, in terms of US markets, they were closed yesterday, but we are waiting for some data. There will be some amount of data coming in from the US overnight. We have the US initial jobless claims, the housing starts, the US building permits. All of that will be out from the US this Thursday. And separately, we do have a GST meeting on Saturday, which is something that I think the street will watch out for, especially when it comes to online gaming. But let's kick off the show with a couple of stocks in focus from the financial space. Kotak Mahindra Bank and City Union Bank are surging on the back of a positive note from the brokerage firm Macquarie, while Macquarie has also downgraded SBI and other NBFCs. Abhishek has all of the details on this Macquarie note.
Well, Ekta, Macquarie has written on financials, and after 5 years, they have upgraded their recommendation on Kotak Mahindra Bank. So they have upgraded Kotak Mahindra Bank as well as City Union Bank from neutral to outperformance. They say that these stocks have underperformed in the last 12 to 24 months. Valuations are attractive, that is cheap, and risk reward is favorable right now. They have downgraded SBI to underperform from neutral after the fact that recent performance from the stock price point of view has been pretty strong, and given the upcoming ECL regulations, decline in return ratios, that is ROA and ROE, and possible equity capital raise makes them downgrade the stock. On NBFCs, they have downgraded Bajaj Finance, Chola Investment, MMFSL from neutral to underperformance. They say that the outlook on loan growth is a key concern amongst these lenders, as well as decline in ROEs and a delayed rate cut cycle which could impact negatively to them. On insurance front, they remain cautious with respect to overall insurance space. However, they have upgraded SBI Life to outperform from neutral, as it is less affected by the EDI regulations that has come in. So they expect it to deliver sector-leading VNB margins of 15% plus, which makes the valuations reasonable in that context in their view. So with respect to stock price, they have increased it for Kotak Mahindra Bank, City Union Bank, SBI Life, as well as Bandhan Bank, while they have decreased the target price on SBI, M&M Finance, Bajaj Finance and Chola Mandalam. Interestingly, for for Bajaj Finance, the decline in stock price is as high as 1,500 per share. Back to you.
Right, Abhishek, that's about the note from Macquarie on financials. But DCB Bank, that's the one which is also gaining on the back of another brokerage note, this one from Motilal Oswal.
Well, Motilal has upgraded DCB Bank, and this comes after, again, 5 years difference that they have had after their previous rating of neutral. So they have upgraded to buy from neutral. Target price has been increased to 175 from 155 that they had earlier. They say that business growth remains healthy and valuations are reasonable at current point of view. So operating leverage to drive ROE recovery for the bank going ahead. So they expect 19% CAGR over the next 2 fiscals with respect to the revenue growth for DCB Bank. So they expect stable net interest margin as well as steady loan growth. Talking about loan growth, they expect recovery in loan growth to happen, and they anticipate improvement in operating leverage as well, that is cost to income ratio to decline. So they estimate earnings CAGR, that is PAT growth, of a 21% CAGR over the next couple of years. They estimate ROA and ROE to reach 1% as well as 14% respectively by FY26, and current valuations of price to adjusted book value of 0.7 times offers favorable for investors. Back to you.
Okay. All right, Abhishek. Thanks very much for that. That's on DCB Bank. That stock is up around 4%. But let's continue focusing on financials. SBI Chairman Dinesh Khara expects 14 to 16% credit growth in FY25, with margins being steady at 3.43%. He adds that excess provisions will help meet ECL norms as and when they do kick in. Listen in.
We are hoping to see the credit growth in the range of about 14 to 16%, and we expect to see very broad-based growth in credit, right from SME, agriculture, retail, and also in the corporate. As far as we are concerned, our domestic NIM last year was 3.43. So I expect our domestic NIM should be around the same number. See, as far as ECL is concerned, first and foremost, I would say that over the period of time, the loan book of the banking system has improved significantly. So if the ECL comes, perhaps whatever competition was done, maybe about a year back, banking system would be much better, and we are certainly much better as compared to where we were last year. So I think from that point of view, we don't expect any kind of an impact on us as far as the ECL is concerned. MFIs are concerned, well, of course, I think the rural went through some challenges at some point of time, but now we are seeing positive trends. But yes, of course, we do hear from MFIs who are having a loan book that there were some challenges. But I think as far as we are concerned, we don't see any kind of a stress.
Right, that's the management of State Bank of India speaking. So we have a bunch of financials in focus, some on the back of brokerage notes coming in from Macquarie, some from Motilal Oswal, and also some commentary coming in from State Bank of India as well. But Office Space Solutions, that's the one that's fired up in trade today. After reporting a good set of fourth quarter numbers, Sonal joins in with more details. The first set of numbers coming in post-listing, Sonal.
Oh yes, and it's been a good one, and they have reported a profit this time around, the first quarterly profit that the company has reported, and that is something that the street seems to like. To take you through the numbers, quarter four revenues are 44%, the EBITDA has grown by 35%. This time it's a profit of 1.3 crore rupees, which compares with a loss of 13.7 crore rupees. Let's talk about the segmental breakup, because their co-working spaces and allied services, which is around 73% of their total revenues, that grew 27%, and the construction and fit-out projects, which is 33% of their revenues, grew by 150%. And if we look at the previous trends in terms of financial year losses, this is the lowest that they've seen in a long time. Losses have narrowed now to levels of 17 crore rupees versus 42 to 57 crore rupees that the company saw earlier as well. The company says that the exit month occupancy for FY24 stood at 71%, and the company is positive on future prospects as well.
Okay, all right, Sonal, thanks very much for that. Well, on that note, we'll take a short break. But up next, we'll be talking to Aditya Khemka of InCred PMS. He's going to be putting the focus on the pharmaceutical space. We have stocks such as Sun Pharma, which are in focus on account of news. We'll be discussing all that and more.
A bunch of mid-caps doing extremely well. We have India Bulls Real Estate, which is spiked to 15% at the high point of trade, at a fresh 52-week high for that stock as well. The other one is Quick Heal. We spoke with the management this morning, and they expect the enterprise business to actually drive revenue for them. And that stock up and away, up around 9% on Quick Heal itself after a near 200% run that we've seen in the last 12 months. But amidst gaining stocks, one of the stocks which is underperforming is Sun Pharma, and this after the company's Dadra facility has received a warning letter from the US regulator. Ekta tells us more.
Well, yes, it is bad news for Sun Pharma that their Dadra facility has received a warning letter from the US FDA. Now, in April of 2024, and to put it into perspective, the timeline will give you a sense that the street was anticipating this to take place. Now, this particular plant was inspected from December 4th to 15th of December in 2023 and was issued 6 observations. After that, in April of 2024, it was classified as an official action indicated status. So the street pretty much knew that there is going to be regulatory action on the Dadra facility based on those 6 observations, as well as the OAI, which was received a couple of months ago. Now it's been escalated to a warning letter. Now, at least, with a warning letter, the production is not stopped of current drugs which they manufacture from the plant. Only future products are stopped. If in case it was worse, such as an import alert, then all production would have been stopped, and that would definitely be more detrimental to earnings. they still, nobody knows whether they would eventually get an import alert, but the timeline of events basically basically indicates that the import alert would have probably already come by now. So that is something that the street is probably a little positive on. Now, the other thing about Dadra is that it also manufactures the API for Revlimid generic, which is an important drug. The overall contribution is expected to be roughly in low single digits. So one will have to see what the impact in terms of earnings would be, if any, when it comes to the Dadra facility. On a larger scale, Sun Pharma is facing regulatory issues. Halol plant has an import alert since December 2022. Mohali has a non-compliance letter which they received from the USFDA. It's a part of the consent decree. Remember that it's a Ranbaxy plant which they got with the acquisition. That they received in May 2023, the non-compliance letter, and now they do have a warning letter for the Dadra facility. But to talk more about Sun Pharma as well as a lot of the other pharmaceutical stocks, we have Aditya Khemka, Fund Manager, Incred Healthcare Portfolio PMS, joining in. Aditya, hi, welcome to the show. So how would you read the news on Sun Pharma, the warning letter for the Dadra facility? Do you think that there'll be a discernible impact on earnings?
So if you look at the warning letter, what it essentially does is it stops new approvals. I think for the US business of Sun Pharma and many other companies, we do pencil in a certain amount of growth from new approvals that comes from these facilities. To that extent, there will be some, earnings downgrade that one should expect, but it will not be very material because from Dadra, it's not too many ANDAs that were pending approval in any case. So there will be marginal earning downgrades, if at all, in Sun Pharma because of this development.
So would you see this dip as a buying opportunity?
Look, the way we look at it, the current valuations of Sun Pharma and majority of the large cap pharma stocks seem to be a little stretched. Remember, the earnings of these large cap pharma stocks, including Sun, Dr. Reddy, Cipla, Cadila, includes a generic Revlimid, which will basically go down to insignificant profits in FY27. Hence, a cash flow, which is a 2-year, 3-year cash flow, probably today is getting a significant valuation multiple, which perhaps is something that, one should be cautious about.
Okay. But Aditya, on a larger scale, do you think that Sun Pharma, how would you read the fact that 3 of their facilities do have regulatory issues? Do you read it as larger companies are much better placed to manage those regulatory issues? Or do you think that this is definitely going to impact their earnings down the road?
So, Ekta, actually, on the contrary, if you see, it's majority of the Indian large companies that have problems with USFDA, which is ironical, agreed. Many of the smaller companies that do the US business seldom fall into USFDA regulatory issues, is what I've observed over the past 10 years. And, hence, I think it's a matter of being able to manage according to the playbook of the FDA at a large scale. At a small scale, I think we still end up managing pretty well. But maybe at a large scale, somewhere, things don't fall in place. So will it impact earnings? Yes, it will. To what extent, that is clearly not very clear because we don't know which ANDAs exactly come from Dadra, which were basically supposed to be launched in the next 1 or 2 years. So we don't have the clarity or the data from the company, and hence we don't know what kind of earnings impact we will have. But it will be minor, and it will be spread over the next 2 years for sure. So I think that's how we read this development. In terms of companies' non-compliance with US FDA, especially larger companies, I think that's something we have been seeing consistently now over the past 10 years. Yes, there is some movement in the FDA's playbook as well. They keep changing the playbook over time. But I think it's high time that Indian pharma companies which want to be, invested into the US business got up to speed to it. I mean, it's been a while that they've been facing these issues, but they keep recurring. And it is disappointing as investors to see that happening time and again.
All right, so branded generics, not your scene here, irrespective of whatever happens. Right now, you believe the valuations are a little stretched. Let's talk about unbranded generics then. What are the names that you like out there? Rather, unbranded generics is not your space. Branded generics is something that you like. Where are the valuations comfortable? What are the names that you own? What are the names that you believe will outperform going forward?
So the names we own under branded generics include RPG Life Science, we own Indoco Remedies, we own FDC, we own many other branded generic stocks, Torrent Pharma, JB Chemicals, so on and so forth. The reason why we like these stocks is because their cash flows are sustainable. These cash flows come from brands that they've built in a branded generic market, and these brands basically go on autopilot growth. Beyond a certain scale, the growth becomes an autopilot mode because the patient and the doctor become familiar with the brand. And these are low reinvestment need businesses because the cash that we generate from this business need not necessarily be invested into capex or working capital. It is cash that can be distributed to shareholders in forms of dividend or buyback, or it can be used to do inorganic growth, as you have seen Torrent and JB do in the past. So that's the reason we like this space, and these are the stocks that we own.
Okay. Do you think that diagnostics is probably the space to be vis-a-vis, say, hospitals in the next 1 to 2 years?
So that's correct. In our assessment, we think diagnostics stocks have derated significantly over the past 2-3 years. But that's not true for all diagnostic stocks. That's true for 2-3 stocks that we own. So we own Krishna Diagnostics and Thyrocare. And for both these stocks, we have seen a significant derating happening over the past 2-3 years. And we feel that the earnings momentum of these stocks in the past couple of years has not been very good. But there have been reasons. They have been reinvesting in expansion, OPEX. And that OPEX, when you do expansion in terms of footprint, the OPEX comes up front and the revenue comes later. So I think that's what's going to happen in these counters, and the derating has been unjustified to that extent. And in the next 2 years, when the corresponding revenue for the expansion comes to the P&L, that's when these stocks will see a re-rating and a profit expansion. And that's really the holy grail of investing, right? To find stocks where there is earning growth momentum, and then, the P multiple also goes up. So that's how an investor makes alpha. So we are hoping to make significant alpha in the diagnostic space over the next 2 years.
What about the hospital space? I mean, diagnostics, hospitals typically go hand in hand. There would be some of the value bets out there.
True. So within hospitals, obviously, we have said earlier that the valuations of most hospitals seems to be very, very stretched. But there are a couple of hospitals that we own, namely Healthcare Global and Aster DM Healthcare, where we feel valuations are very, very comfortable, where we feel earning growth will be fairly good, and there is room for multiple expansion in both these stocks.
Okay. Just quickly on hospitals, what are you advising your clients when it comes to this entire uncertainty with regards to standardization of rates? And do you think that's impacted investments into the sector?
So no, if you look at the private equity space, after this entire standardization of rate thing came up, there have been actually more private equity deals in hospital space after the announcement. So I think by and large, the entire industry and the investor community has taken a stance that the standardization is just not practically possible, given that the cost structures of different hospitals in different cities with different specializations is so very different. To have one standardized rate across the board just, seems very impractical when we talk about it. And hence, I think it has been something that people have put behind them. It is not something that people are taking into consideration today. And hence, we don't believe there is a business impact coming forward in the hospital space. What we are cautious of is the valuation at which you're buying the asset. Some of the larger hospital chains which are listed, their operating cash flow to EV is 1.25%, which means in sense of EV to OCF multiples, they're trading at 80-90 times. That's closer to what a DMart or a Titan is trading at. And if you look at some of the smaller hospital chains where earnings are good, cash flow is good, they're trading at 20 times EV to OCF, which essentially means that these are not even getting the value that these hospitals used to get 10 years back. So I think that's the kind of polarization in valuations we have noticed in the space in the past 2 years. And we are hoping the stocks will converge, the valuations will converge. And that's how you create alpha in being in the right space.
Right.
Okay. Just quickly before we, wrap up this conversation, Aditya, I was reading a very bullish note on the CDMO space. There's a lot of interest in the likes of Piramal Pharma as well as the likes of Syngene, the biotech funding, the China Plus One opportunity. All in all, what's your take on it, and which are the stocks that you have in your portfolio to probably play that theme?
So in the CDMO space, we really like the companies that do true CDMO, which means companies that engage with contract development manufacturing activities with the innovators. It has become a slightly abused word because companies that do contract manufacturing for generics also have started calling themselves CDMO. And I think that's not really, the jargon that the industry wants to use. We like companies like Jubilant Pharmova, Syngene, Hycal, Newland, because if you see a majority of their revenues or profits are actually coming from businesses which they do with innovators. Why innovators? Because one, the innovator business is small volume, high value, high margin, and hence high ROE. And two, it is a sticky business because the innovator has a patent protecting it from competition. And that enables the business to be recurring in nature and the cash flow to be recurring in nature. So we really like these companies, this business model. And that is where I think the China Plus One and the Biosecure Act, those tailwinds will actually play out in that particular space. It need not necessarily play out on the generic space. And the companies that we own in this bucket are Syngene, we own a Newland, we own a Jubilant Pharmova, we own, a couple of other Hycal, a couple of other names like that.
All right, Aditya, thank you so much for joining in and putting the spotlight on the pharmaceutical, healthcare, diagnostics and hospital space, telling us that Sun Pharma, while it may not impact the current US FDA issue, may not impact their financials as much, valuations anyway are stretched. Meanwhile, while we were having that conversation, there was some update that came in on Goa Carbon. In fact, they've gone ahead and introduced a new product, and this is called G Carb Plus, and this is to revolutionize the recarb business. So the recarb business, which basically will have lower sulfur content, significantly reduce harmful emissions, and supporting environmental sustainability. That's what a lot of the clients would perhaps be looking for. So new product launch, the prospects of that have the stock higher by about 8%. We'll take a short break, come back, focus on the markets. Aditya Agarwala of Invest for Edu will join in with some trading strategies. Welcome back. The market's holding up, doing well actually. The Nifty up around 40 points. We have the mid-cap index doing a lot better. So if you just take a look at the key indices today, we'll have the Nifty and the Nifty Bank come up for you. The Nifty is up by about 38 odd points, whereas the Nifty Bank is doing a lot better. And the reason for the Nifty Bank having doing a lot better is the fact that it broke out yesterday, hit a fresh record high after a spate of underperformance, and now money is backing Nifty Bank. If you just take a look at the FII flows in index futures yesterday, where they turned net long in index futures, they actually bought a net of around 4350 crores, and entirely all of that, close to 4370 crores, was directed towards the Nifty Bank futures itself. So maybe it was as if the FIIs were waiting for the Nifty Bank to break out before committing more money to the Indian indexes or index futures itself. And now we have some other pockets which are doing well as well. Metals for one, Hindalco, Tata Steel, Vedanta. Vedanta, we had the interview with Anil Agarwal as well. All these stocks doing well. And fertilizers seem to be the pick of the pack in today's trading session as well. Chambal Fertilizers, RCF, NFL, and FACT. But now, in the last 20 minutes or so, we're also seeing some pickup in the IT pack. So the IT index is something that I will keep an eye out on. It's mildly in the red right now. If that picks up, then maybe we could see a further gain on the Nifty. Until that happens, maybe the lid on the Nifty, when it comes to gains, comes at around 23,600 thereabouts. Why do I say that? Because we have the weekly options expiry playing out as well. 23,550 call has a premium of almost 30 rupees, telling you around 23,580, which is closer to today's high. We'll see some sort of supply. 23,600 call writers also very active for a premium of 50 rupees. So immediately above 23,600 is some resistance as well. But strong support coming in at lower levels. 23,475 thereabouts would be the support for the frontline index. And a lot of stocks in focus because of entering or exiting F&O ban. Birlasoft, GNFC, Punjab National Bank, all of them may enter F&O ban. So keep an eye out on that list that comes this evening. And India Cements actually may exit F&O ban. The stock price move is telling you that as well. So maybe that's something that we'll keep an eye out on too.
Okay, all right, Mangalam, thanks very much for that. Aditya Agarwal now joins in to discuss the technicals of the market. Aditya, hi, welcome to the show. But let's start by talking about a couple of these stocks which are under pressure. M&M, Sun Pharma, Hero Moto.
Good afternoon, Ekta. Good afternoon, Mangalam. Thanks for having the show. There is a bit of pressure here and there, Ekta, without a doubt, and they'll be seeing profit booking in some of the names. To start with, Mahindra. Honestly, it was on cards. We were seeing a massive up move. We had seen massive up move last month, and that led to overbought levels on shorter term time frame charts, and that was suggesting that there could be some kind of profit booking in Mahindra. Having said that, yes, the trend still remains upward. I wouldn't say that the trend has reversed, but then the correction can extend a bit more, maybe closer to about 2800. Now, if I talk about Sun Pharma, that too has seen a bit of profit taking, and there was a distribution pattern there as well. Which was visible. So I think it will enter through a sideways consolidation phase, and then probably we can see a pickup. While that happens, the pharma stocks are seeing some kind of a buying pattern. So overall, I think there are some pockets which are seeing profit taking, and the money is shifting maybe from one sector to the other. Like all of the banking stocks, you pick, they're doing well. The fertilizer stocks are doing well. All of them are doing phenomenally well. Some of the home-related stocks are doing well, housing-related stocks. So I think there's a bit of a shift that we are seeing at the moment in the market.
All right. So talking about that shift, how do you play that shift through stocks, Aditya?
So Mangalam, I've got a couple of buy recommendations clearly because of the undertone remains strong. One sector that I'm seeing some kind of a buying is the footwear industry. So look at the way most of these footwear stocks are going up. Looks like there is some kind of a buying pattern which can emerge in India as well. Stock has been a massive underperformer, and looks like now it has formed a base finally and is getting up for a short covering rally or maybe a fresh long positions in Bata as well. So at current levels, the risk to reward is in favor of going long for a target of 1540, 1550. On the upside, I'll take a fresh long position in Bata with a stop loss at 1425 on the downside. The second is again from the city gas distribution MGL. I think so. After a decent up move, stock has finally broken out from that trend line resistance that it was facing for a couple of trading sessions. On the upside, 1600 will be the target. On the downside, 1410 will be my stop loss.
Okay, all right, Aditya, we're going to let you go on that note. Thanks very much for joining in and giving us all of those stocks in focus. Well, for the Bank Nifty, holding up with a gain of around 0.5%, no complaints coming in. And the advanced decline ratio is extremely positive. A lot of these metal stocks doing well. So Hindalco, for example, is up around 2.8%. Reliance is doing well today, so that stock is up around 1.3% at this point in time. We'll take a short break, but up next, we'll get you an exclusive conversation with Anil Agrawal, founder and non-executive chairman of Vedanta. Stay tuned. Welcome back. Well, let's get you a CNBC-TV18 exclusive. Anil Agrawal, founder and non-executive chairman at Vedanta, believes that the metal industry is in a super cycle. Our colleague Nigel caught up with him to discuss their business outlook. Listen into excerpts of that conversation as he talks on his EBITDA target, demerger plans, and says he expects a valuation of $1.2 billion per MT for steel assets.
$10 billion is if you look at, we are the largest producer of zinc, silver. We are the only people in India doing the largest recycling of our slag, recycling, which is the most environmental friendly. So we are very confident. Aluminium, we are the largest producer, 3 million ton integrated. Everything, if you look at our iron ore, look at our iron ore, we are going to produce 70 million ton of iron ore. If you look at our oil and gas, I'm so excited about oil and gas. We have offshore, we have onshore. We are the people who are producing and started exploring and the drilling program in the Northeast, especially in Big Boy and all the Assam area. So very excited about oil and gas. Each of our assets are a trophy asset.
Now, you've talked about all these businesses, put it together, but also what the street is looking forward to is the demerger of these businesses. Could you tell us the timelines and have approvals come through?
Yeah, it's all done. It's all, we have got majority of lender approval. We are in the process. NCLT take time and go through a whole process, which process will take place, and then it will be merged.
So by the end of this fiscal year, we could have the units separated, 6 listed entities of the Vedanta Group?
I think so, because certain things are in my hand, certain things are not in my hand.
Okay.
It is in the hand of NCLT. NCLT normally take 3-4 months time, but sometimes they can take 1 or 2 months more also.
The other focal point, Mr. Agarwal, is the steel business. I'm aware that you're in conversation with various buyers, and maybe in the next couple of quarters that should get closed out. How sure are you? In the first half of this fiscal year, should we see that steel asset getting sold at a good valuation? You want to give us a hint of the valuation you're looking for?
See, first of all, on the demerger, it was absolutely important because each of our business is a independent business. And my vision is to time to come, each of the 6 businesses will be as big as Vedanta itself, because the huge demand and the demand is double-digit growth. So I'm very excited about to create value for my shareholder. Each of my shareholder will get, if he has a 1 share of Vedanta, will get 6 share of demerged company. So that was on demerger, and that was the right thing to do, making a very strong with the management. As far as the steel is concerned, we are one of the best prime location of a steel asset, which is in Jharkhand, near Bokaro, is in the Bokaro. We have a proximity of all the raw material, iron ore and the coal. We are proximity of all the railways. We are proximity of all the gas. So this is the best location for anybody to start production of steel. Very clearly, our Prime Minister has said that there will be 300 million ton of steel production. And India is at the moment producing only 120,000 ton. So the huge demand supply gap in steel. So this is the one thing which is a brownfield, which can produce 20 million ton of steel. So we have put this asset on the basis that if we get 1.2 billion per million ton, we have a 3.5 million ton of plant, which at the moment we are producing close to 2 million. 3.5 will be by end of this year. So we are 100% sure that if we get $1.4 billion and get not the distress sale, if somebody has a vision to produce, take it forward, we will look at, and if we get a price of $1.2 billion per million ton, we may consider to take the view.
All right. So your ask is that per million ton, you want around $1.2 billion. Are we getting that correct?
3.5 million ton. 3.5 million ton.
So what is the total valuation you're seeking for this 3.5 million ton plant?
Yeah, around 4.5.
4.5. Okay. All right. That appears to be a tall ask. And how confident are you that you see this getting closed out in the first half of the fiscal or sometime during the fiscal itself?
We are very comfortable. Every of our shareholders want us to be in the steel business. We are already producing almost 2 million ton steel in Goa. So both put it together, it will be 5.5 million ton. We have strategically decided not to be in a steel business or become very big in the steel business. So we are getting very good response internationally and nationally. This is a very good, if you look at, this is the norms of the price, 1.2 billion, because the assets are not available. If anything comes, we look at, otherwise we keep expanding our plant.
You look at the Nifty, you look at the Nifty Bank, and then you look at the financials, and you would see 3 different markets. The Nifty holding up, about 23, 24 odd points. The Nifty Bank doing a lot better with about 208 points up. But the financials, now they're spiking and they're doing well as well. So we have something like a Piramal Enterprises, which is now up at the high point of trade. We're seeing some traction in L&T Finance as well. And mind you, this is at a time when Bajaj Finance is actually lower on account of that Macquarie downgrade that has come by. All the other financial stocks are doing extremely well. Also, we're seeing some traction in gas-based stocks. So we have GAIL, which has now moved higher. GAIL is at the high point of trade. We're seeing some traction in Gujarat Gas as well, which has recovered from the lows and has moved to the high point of trade as well. So a bunch of stocks doing actually a lot better. And from the start of trade to even now, we have seen, a decent advanced decline ratio on the indices. So if you just take a look at the broader markets, you would see that you have more stocks advancing, way more stocks advancing than the number of stocks which are declining. And that line has remained parallel even as the Nifty went through its ups and downs. But it's the GST Council meet, which will be in focus on Saturday for the first time since Lok Sabha elections, for the first time over a year as well. Sources have told CNBC-TV18 that the council is considering putting some tax on spectrum allocation in the telecom sector as well, alongside discussions to reduce taxes on supplies collected at source for e-commerce companies, TCS, as we know it. Tim C joins in with the latest on that one. Tim C.
Well, that's right. It seems to be a full plate for the GST Council, which is likely to meet on 22nd June. Sources say that the Council is likely to clarify on issues with respect to GST levy on spectrum allotment to telecom companies. Council could say that GST levy on payment of license fees, spectrum usage charges applies on the due date or the payment date, whichever is earlier. And in case of installment payments or deferred payments, GST should be discharged accordingly. Similarly, a clarity is likely for the highway builders. Sources say that under the hybrid annuity model, a builder is liable to pay GST at the issue of invoice or payment receipt, whichever is earlier. In case there is an interest component on installments or the annuity payable by NHAI to the builder, even that will be taxable. Council is also likely to issue clarification on a plethora of issues, including taxability of reimbursement of shares as ESOPs, also providing clarity on the corporate guarantee provided by related persons. Also, clarity is awaited on wreck and salvage values in motor insurance claims. Clarity is likely to be extended on whether there is a clear decision on extended warranty provided by manufacturers to the end consumer. Several proposals of the insurance sector, such as supply between lead insurance and co-insurer, on transaction of ceding commission between insurer and reinsurer. The council is also likely to reduce the rate of TCS collected by e-commerce operators for supplies made through them from present 1% to 0.5% and a lot more. Let's see what all does the council take up when it meets on June 22nd.
All right, MC, thanks a lot for that. As we slip into a short break, let's listen into some excerpts coming in from our conversation with Krishna Sangvi of Mahindra Manulife this morning.
Financials would have been a natural port of call considering the ownership pattern. So that's where some money gets taken out to invest somewhere else. See, let's look at macro picture of economy. I think all sectors are interlinked. We have this concept of profitable participation, where some sectors lead the earning growth, some sectors lag it, but net economy keeps on growing. A lot of capex announcement which would have happened earlier are possibly likely to continue. So it's going to be more of a valuation call, and that's where the thought process comes in, is that as and when some of those capex cycles which was initiated some time back starts getting played out. See, what's the end game of capex cycle, right? End game of capex cycle is higher manufacturing, which creates income for people who are employed. So it's job creation. It's some Indian factors of production being paid out as a part of this cycle.
Fertilizer stocks doing extremely well. So FACT has now hit an upper circuit of 20%. So locked in that upper circuit. We're also seeing Paradeep Phosphates, the chemical related company, up around 12.5%. And we've seen some traction in volumes out there as well. A couple of other stocks which are doing well. Metro Brands, second day running, the stock's done well. So this week itself, the gains have been upwards of 13%. So Metro Brands should come up for you on the screen. Also seeing some traction in names like Mahindra Holidays. So Mahindra Holidays up around 6%, 7.5% off the lows. I'm sure some positive commentary was made in the Mahindra analyst day that took place, group analyst day that took place earlier in the week as well, or late part of last week. So that's the reason that stock is doing extremely well. For them, they have a leadership change coming in too. But that's about the equity space. Manisha joins in with all things commodities. Manisha's ready. Manisha.
I am. And I'm going to talk about palm oil prices and, of course, the details around that. Sandeep Bhan is CEO, SD-Guthrie International Trading, and he joins us now. Sandeep, hi, thank you so much. And I want to talk about the prices first, which have been quite volatile when you look at this year. I mean, we started this year quite low at 3260 Myanmar ringgit per ton. We've seen a high of 4,500. We seem to be holding below 4,000 at this point in time. What are the fundamentals that you're watching, and what's your sense on prices going forward?
See, the prices have been trading in the range of 38 to 4,000 ringgit on the futures market here. When it comes to 4,000 or market crosses 4,000, a bit of a resistance is there at higher levels, and you see good selling coming down. And market goes back down to 3,900, below 3,900, between the range of 38 to 3,900. There's a very good support. All this is backed by the buying from India, and also, secondly, from the palm oil getting back to the cheaper oil. We have now palm oil discount to $100 against soybean oil and close to $125 discount to sunflower oil. That is making it very cheap oil among all the complex of edible oils. And that gives a bit of a demand coming back to the palm oil, which is giving the 3,800 to 3,900 a good support level.
Also, Sandeep, where do you see a resistance now coming in?
4,000 remains resistance in the current market fundamentals. Anything above 4,000, we see a good selling coming in. So
Sandeep,
kind of
also,
it's a range-bound market between 38, 39 on the sport side, 4,000 above, a bit of a resistance side. So it's been trading all along between 38.50 to 4,000 range.
That's a very tight range that we've seen palm really coming in. But Sandeep, with the kind of imports that we've seen for the month of May have been quite on the higher side on a month-on-month and an year-on-year basis as well. I mean, as you said, because the prices are now back in discount to other rival oils, perhaps seems to be supporting. But how are you looking at this year going forward now? On a month-on-month basis, what kind of imports will India do in sense of palm? An annual number as well for 2024, if you can share with us, if you've done any calculations.
We are very positive on the Indian demand now, with prices of palm oil going back to cheaper discounts against soybean and soft oil. We should see palm exports to India back to the range of 850 to 900,000 tons in coming months. We also have to factor in that the festival time when Diwali will be coming in, and we will have to, India will see a big time buying of palm. Overall, in a year, we think last time we had discussed it that we might drop it down to 7.5 to 8 million tons because of the palm getting into premium. But I think with the palm going back to discount, we should go back to 9 million tons in the year.
Okay. Sandeep, there's various conversation really. And how are you basically reading on what HUL talked about in sense of lowering the palm content in soaps by 25%? I mean, two things that they talked about. One was environment and the other was the price volatility that we've seen in sense of palm.
See, their buying is mainly into the palm fatty acid distillate, which they use for the CPO, which they use for their soaps. But that quantity is not that big. It's close to, I think I was told, around 10,000 tons a month. But that's not going to make a significant impact on the PFAD market.
All right. Sandeep, also, how are you looking at the overall industry now going forward? Because we've seen the mandates in sense of biofuel from palm also perhaps starting to come back. So when we go forward, what is the kind of categorization that you see coming in from palm? As you said, it perhaps is going to be 9 million tons that India will import annually. Apart from that, where do you see the usages, especially when it comes to Malaysia and Indonesia?
See, Indonesian biodiesel program is a very successful program. They are heading towards B40, and the industry is doing very well in Indonesia, and that is giving a lot of support to the Indonesian prices locally. In terms of overall industry, we see India and China, which was missing in the first half of this year, has been last couple of weeks buying virtually every day they've been buying. India is big time into the markets. So we are seeing a shift of global demand back to palm, mainly because of palm being now the cheapest oil among all oils.
All right. I'm sure because India being one of your largest markets, Sandeep, you would be looking out at the government reforms, policies, etc. going forward. And while, of course, we have seen National Palm Oil Mission as something that has been talked about in last couple of budgets, how are you looking at various steps, conversations about self-sufficiency when it comes to edible oil, push towards palm? How are you looking at this trajectory?
we are one of the supporters of the national oil seed missions in India. And in fact, we are one of the big seed suppliers to Indian importers. So we are looking for the success of this program. But besides that, the Indian consumption of palm oil is only going to grow. We are not seeing any dip in the consumption in coming years. It's only going to grow.
Any percentage number that you're working with in that sense, Sandeep, on how much percentage of palm oil demand India can see growing?
I won't be surprised seeing India importing 10 million tons in coming years, maybe next 1 or 2 years' time.
All right, Sandeep, thank you so much for joining us. Well, that's all about the palm, which is used right from your lipsticks to cosmetics to food to processed food and soaps. And you can perhaps continue with that.
The chips.
The chips. You had to add that one on. So as Sandeep said, 9 million tons is what we're looking at this year and 10 million tons going forward. So palm is something, the cheapest oil that we will continue to import going forward. With that, it's a wrap on this halftime report, but Business Lunch will take all the action ahead.